Hello everyone, Mike and Marie Gratland here, and we wanted to give everyone an update on the current housing market, specifically here in Ventura and LA counties. Let me start by saying this is not financial advice. I'm just sharing with you my own research and some things that we've been seeing in the past couple of weeks here in the market that I think you'll find interesting. And of course, as new information becomes available, I could change my view. But my current view is that we are definitely seeing a change in the market. The real question is, will this be a market shift like we saw in 2008, or will it be like the fake out we saw in 2020? I'm going to cover both of those time frames in this video. Let me start by saying that many of you have heard that the real estate market is on fire. And by every metric, that's been true for the past decade. From about 2012 to 2020, we saw a steady rise in home values. And from mid-2020 on, we've seen a significant spike in home prices. And it's been extremely competitive to buy a home. If you've tried to buy a home in the past 2 years, you know what I'm talking about. People were doing crazy things like no loan contingency, no appraisal contingency, free rent backs, and things like that just to get into a home. In this video, I'm going to give you my perspective on what happened in 2008 and also what led to the current state that we're in. We all know the simple economics of supply and demand. When demand is high and supply is low, prices go up. To understand housing supply and demand, we're basically asking this question. If no other homes come on the market and we continue to sell the same amount of homes we do every month, how long would it take to sell every home on the market? To understand this housing supply and demand, we're basically asking this question. If no other homes come on the market and we continue to sell the same amount of homes every month, how long would it take to sell every home on the market? So for example, let's say we have 100 homes on the market and we sell, say, 25 homes a month. How long would it take to sell all the inventory? So to find the answer, we would take 100 divided by 25 equals 4. So we would have 4 months supply of homes. So using this illustration we put together, if we have 0 to 4 months supply of homes, we're in an uptrending market, meaning prices are going up, right? If we have, say, between 4 to 6 months supply, we're in an equilibrium stage, meaning prices aren't falling, but they aren't rising either. If we have more than 6 months supply, that's when we see prices drop. And just to kind of give you an idea of what's happened in the past, in 2008 to 2010, we had about 12 months supply of inventory and our home prices dropped close to 50%. And then conversely, in the past couple of years, we've seen inventory under 2 weeks in supply and prices rose 20% in a single year. So those are the two extremes. So I put this chart together so you can actually see the correlation. In blue, we see the inventory levels, and in green, we see the home prices. As you can see, when the inventory goes up, prices come down. And when inventory goes down, prices go up. The main point of this is that the correlation between supply and demand versus home prices is undeniable. And what about that little blip at the end of this chart? I mean, it's flat for 2 years and then it starts to rise right at the end. Well, that's the purpose of this video. That's the change I'm referring to and begs the question, are we headed for a major correction or will it be a temporary blip like 2020? And looking at this, you might be thinking, what the heck is that anomaly in 2020? Well, the market crash of 2008 is well documented, but what about 2020? I mean, I mention it and many people may not even know what I'm talking about. A little known fact is that in early 2020, our inventory level went above 6 months for a short period of time due to the government lockdown and major uncertainty of what was happening at the time. So it was temporary. But then a couple things happened in March of that year. First, they declared real estate an essential business, right? And they reduced interest rates down to 0 to stimulate the economy. That meant that you could get a mortgage rate for as low as 2.5%. What was the result? Well, we know the result. Everyone started buying homes. Everything that was listed for sale was purchased immediately, and our inventory dropped to less than 1 month's supply, and as low as 10 days, even less in certain price ranges. So in one instance, in 2008, when inventory rose, prices came down. In another instance, 2020, inventory went back up immediately, and prices continued to rise at an even faster pace than before. But I think the instance in 2020 was due to the drastic moves made by the Federal Reserve, and I don't see that happening now. Again, with more information, that would change, but I'm not seeing it right now. And you might be saying, okay, yeah, this is great to know, but by the time we get to 4+ months of inventory, everyone knows the market has shifted. And by that time, we'll see homes sitting on the market for longer. We'll see a lot of price reductions. We'll see homes being taken off the market, unsold. So is there a way to know sooner? In other words, are there other indicators that might point out a market change sooner than just inventory levels? The short answer is yes, and that's what this video is about. There are actually 3 other indicators that give us clues. None of them by themselves are obvious, but when taken together, I think it makes a compelling argument that we're definitely seeing a change in the market. The 3 other indicators are interest rates, rent versus owning ratios, and home affordability. First, let's take a look at interest rates, because a lot of people are under the impression that all you have to do is follow the interest rates, because logically, your interest rate affects your buying power. So a lot of people assume when interest rates go up, prices must come down, right? Well, actually, historically, there hasn't been a correlation between interest rates and home prices. To see what I mean, take a look at these 2 charts here. Here's interest rates between 1971 and present day. Notice that just before the bubble burst in 2007, interest rates were relatively flat, hovering around 6%. Now take a look at, here's home prices in the same time. Notice that when we look at that same period, home prices actually went up 70% at that time. Interesting. And check this out. Going back to that interest rate chart, take a look at this huge spike in interest rates in the early 1980s, when interest rates actually rose above 18%. Going back to the home value chart, if there was a correlation with interest rates, we would definitely see a dip in the early 1980s, right? But there isn't one. In fact, home prices actually rose during that period. So there's no data to suggest that there's a direct correlation between interest rates and home prices historically. But historic data doesn't guarantee future performance, and there's no denying the fact that purchasing power does go down with rising interest rates. Now let's talk about renting versus owning, because this I think is the big one. Before we talk about the current market, I think it's important to take a look back at 2007. One thing I want to mention about that era is lots of people got into adjustable rate interest-only loans. There have been books, documentaries, movies made about the housing crash of 2008. The Big Short comes to mind. Great movie, by the way, if you haven't seen it. So I'm not going to go over every aspect of what happened there, because many people have done that. But what I think is missing from a lot of the discussion is why people were willing, or why were people flocking to buy homes in those years before the crash? And why were they willing to get into these adjustable rate interest-only mortgages in the first place? I mean, surely not everyone was swindled, right? Many people took calculated, logical decisions based on current information that they had at the time. And that information was A, by buying a home, the monthly mortgage payment would be less than renting an equivalent home at that time. And B, home values had been increasing for 17 years or so. And so they assumed that home values would continue to increase, and therefore they'd be able to either refinance when the rates adjusted, or they could sell it for a profit. Most discussions that I've seen have revolved around this, that are on this topic, revolve around other things. But I want to hone in on the fact that it was cheaper to own versus rent. When it's cheaper to rent versus buy, people will rent. And when it's cheaper or equivalent to buy versus rent, people will buy. Simple as that. Now, I'm strictly talking about the economics here. There are certainly other benefits to owning a home that come into play, like the fact that you can make changes that you want to the property, tax benefits, paying down the loan, long-term appreciation, etc. But the main consideration when you're buying, especially your first home, is which one is cheaper. And from 1997 to 2006, it was cheaper to buy versus rent. Then it flipped in 2007. In 2007, it actually became cheaper to rent versus paying a standard mortgage payment. How much? Well, here in Ventura County, it was $640 a month cheaper to rent than it was to buy. And what happened next? When those adjustable rate mortgages started adjusting at higher rates, people began to sell and there became more sellers than buyers and prices dropped like a rock, right? So if you're looking for an early indicator of a market correction, it would be renting versus owning. Now let's take a look at renting versus buying a home right now versus before interest rates began to rise. Let's take an average home for say $800,000. And for this example, let's take a buyer with 5% down just to keep the numbers simple. At 2.75% interest rate, the monthly payment would be $31.69 a month. If you were to rent the same house, it would cost about $3,700 a month. So if I'm considering renting versus buying and it's $500 a month cheaper to own, heck, this is a no-brainer. I'm buying. But now let's take a look at that same house with 5.5% interest. The monthly payment would now be $43.81 a month. Now all of a sudden it's almost $700 a month cheaper to rent. Here's the thing. That switch just happened. That's why our inventory has gone up 64% in 3 weeks. Yes, take a look at that chart again. That little blip there at the end in blue on the far right, that small little uptake at the end, that's a 64% rise in inventory in 3 weeks. That's why realtors are reporting less activity on their listings, because homes just became unaffordable to a lot of people. Here's something else to think about. $1 million homes have been selling like hotcakes for 2 years. It wasn't that people could necessarily afford $1 million house, but they could afford the $3,800 a month payment. Now that same $1 million home 2 years later is now $1,350,000, call it, and the payment is now $7,400 a month. So where is the next wave of home buyers going to come from? Because to keep these prices moving up, we have to have more buyers than sellers. Definitely something to think about. And one more thing. Let me go to the last indicator, and that is the home price to median income ratio. Take a look at this chart here. Historically, home prices were between 4 and 5 times the median annual income. In 2007, home prices shot up to 7 times annual income, which was higher than at any time in history. Then what happened? The market came crashing down all the way back to an affordable number based on their income. Now look what it's done over the past 2 years. It's now blown past 7 times and almost touching 8 times annual income to purchase a home. You take all 4 of these indicators combined and you might be seeing what I'm seeing here. So what does all this mean? Because I've always said, I don't have a crystal ball and I don't know the future. And each of these indicators doesn't necessarily predict the future. We also know that real estate is not like the stock market. The stock market could change 15% in a single day, whereas real estate is more like a giant ship that takes a long time to turn. What I am pointing out is that the ship just made a turn. Maybe it's just a small turn and it'll go back to the same course that it was on. Or maybe it'll be a 180-degree turn like in 2008. I have no idea, and only time will tell. But the ship has definitely made a turn, and I wanted to point it out to you. How does this affect you? Well, if your goal is to live in your home for 5+ years, I wouldn't do anything. I mean, I'm not selling because I plan on being here for a while. And if you're planning on buying with a larger down payment, these economics don't affect you as much. And plus, you need a place to live, right? And if you're making a lateral move across town, does trying to time the market really matter? Again, you have to live somewhere. But if you were trying to time the market, or if you're thinking about selling within the next year or so, you might want to consider moving up that clock before everyone else notices that we've made a turn. Again, this is not financial advice. Do your own research. I'm simply sharing with you my research and what I'm seeing here on the front lines on the market. As always, thank you for watching the video. If we can help in any way, please give us a call.